Welcome to our deep dive into futures trading. If you've ever wondered how investors bet on future prices, that's exactly what futures trading is all about. It's betting on commodities or financial instruments. It's futures contracts are agreements to buy or sell an asset at a predetermined price on a specific future date. These assets can range from oil and gold to stock indices and currencies. Case standardized, exchange traded, and legally binding. So, why trade futures? They offer several key advantages. First, leverage. You can control a large contract value with a relatively small amount of capital. Second, hedging. Businesses use futures to lock in prices and protect against adverse price movements. Third, speculation. Traders aim to profit from predicting future price directions. However, futures trading also comes with significant risks. The high leverage can amplify both gains and losses, potentially leading to substantial financial exposure. Market volatility is a key concern. Margin calls and complex contract specifications require a thorough understanding and disciplined approach. Before diving in, it's crucial to educate yourself, understand market dynamics, and practice risk management. Futures trading can be a powerful tool for diversification and profit, but only if approached with caution and knowledge. Join us next time for more insights into the world of finance.